The Strait of Hormuz ceasefire changes nothing. I know that sounds extreme. Markets rallied. Oil pulled back. Financial media declared the crisis contained. But here is what nobody on your timeline is telling you. The Persian Gulf is not just the world's most important oil choke point. It is the world's most important fertilizer choke point. And fertilizer has no strategic reserve. There is no emergency stockpile. There is no release valve. The ships that were at sea when the strikes began are still arriving at ports across South Asia and East Africa right now. Behind them, there is nothing. The 2026 spring planting season for corn, wheat and soybeans across the Northern Hemisphere is closing on a biological schedule that does not care about diplomatic calendars. The fertilizer that needed to arrive in March and April did not arrive. That damage is already in the ground. And in the next 10 minutes, I am going to show you exactly why this is the most important commodity story of the decade, what it means for global food prices, and the one thing most investors are completely missing about how to position for what comes next. Here is the machine nobody has been watching. Think of global food production like a three-legged stool. The three legs are nitrogen, phosphate, and sulfur. You need all three. Remove any one, and crop yields drop dramatically. Remove all three at once, and you are looking at something that has never happened in the modern era. The Persian Gulf supplies roughly a third of the world's traded urea, which is how most nitrogen reaches farms. It supplies 20 to 30% of global ammonia exports, and it supplies about a quarter of all traded sulfur. Iran's 7 urea and ammonia plants are shut down. Qatar's Ras Laffan complex, the largest LNG and gas processing facility on Earth, declared force majeure. The bypass routes through Oman that shipping planners counted on were knocked out by drone strikes in the first weeks. So picture a kitchen. You have a recipe that calls for 3 ingredients. The store that supplies all 3 just closed. The backup store is also closed, and the dish has to be in the oven by May, or it does not get made at all. That is where global agriculture is right now. And this is the part that makes the fertilizer supply chain disruption categorically different from the 2022 Ukraine shock. In 2022, the disruption hit one nutrient, nitrogen, from one source, Russia. This time, all 3 nutrients are disrupted simultaneously from multiple sources flowing through a single choke point. Let me give you the numbers because this is where the Strait of Hormuz crisis 2026 becomes impossible to ignore. War risk insurance premiums for tankers transiting the Gulf jumped 4 to 6 times their pre-crisis levels. That alone makes most shipments economically unviable, even if the waterway is technically open. Global urea spot prices have already risen over 40% since late February. Ammonia is up even more. And here's the number that should keep you awake at night. The last time a disruption roughly half this size hit global food systems, in 2007 and 2008, rice prices jumped about 180%. Wheat rose about 130%. 48 countries experienced political instability. And that crisis started from a lower price baseline than where we sit today. Now layer this on top. The 2026 spring planting window for the Northern Hemisphere is a fixed biological deadline. Corn in the US Midwest needs to be planted by mid-May. Spring wheat across the Canadian prairies and Northern Europe has a similar window. Once that window closes, it does not reopen. There is no overtime. There is no extension. The fertilizer that needed to be in the ground in March and April was not there. A 2-week ceasefire announced in early April cannot restart Iranian ammonia plants, rebuild Qatari LNG feedstock, normalize shipping insurance, and deliver product to farms in time. The math does not work. That is the situation. But here is what almost nobody is asking. What does this actually mean for your money? If you are a long-term investor, here is where this story hits your kitchen table. The base case scenario, which Santiago Capital assigns a 45% probability, is a prolonged disruption lasting 3 to 6 months. The market is still pricing the optimistic 30% scenario, a short disruption that resolves cleanly. That gap between what the market expects and what is likely is where the opportunity lives. And the risk. Think about what is exposed. Any nation that imports more than half its calories is facing a food inflation shock that monetary policy cannot fix. You cannot raise interest rates to grow more wheat. Countries across North Africa, the Middle East, and South Asia are on the front lines. Egypt imports more wheat than any country on earth. Pakistan depends on Gulf ammonia for its fertilizer production. Bangladesh, Indonesia, Sub-Saharan Africa. These are the dominoes. For commodity investing in 2026, the implications are direct. Agricultural commodities, specifically wheat, corn, and soybean futures, are pricing in a disruption that is far milder than the one that is actually unfolding. Fertilizer producers with non-Gulf supply chains, particularly those in North America, are structurally advantaged. And gold, which rose roughly 2,000% during the 1970s stagflation, continues to function as the asset that performs when the systems built for peacetime stop working. North America is the most insulated region on Earth right now. It produces its own nitrogen. It has its own phosphate. It grows its own food. That structural advantage has not been fully priced in. So, what are the paths forward? Scenario 1. The ceasefire holds. The strait fully reopens, shipping insurance normalizes over weeks, and fertilizer begins flowing again by late spring. That is the 30% case. Even in that scenario, the 2026 Northern Hemisphere harvest is diminished. The planting windows that closed while diplomats talked do not reopen. You still get elevated food prices into 2027. Scenario 2, and this is the 45% base case. The disruption drags on 3 to 6 months. Iranian plants stay offline. Gulf exports remain fractional. War risk premiums stay elevated. In this world, global food prices spike materially. Sovereign credit stress emerges in import-dependent nations. The political instability that followed the 2008 food crisis repeats, but from a higher baseline and into a more fragile geopolitical environment. The cost of carrying the right exposures, agricultural commodities, fertilizer equities, gold, real assets, in a world where scenario 1 plays out is modest. You give back a small premium. The cost of being unpositioned if scenario 2 plays out is severe. That asymmetry is the entire investment case. Here is what I want to leave you with. The most important number in global markets right now is not on any trading screen. It is not in any central bank report. It is in the ground. It is the nitrogen that was not applied to 400 million acres of farmland across the Northern Hemisphere this spring. That number will express itself 6 to 9 months from now, on grocery shelves, in sovereign bond spreads, and in the headlines that will seem sudden but were entirely predictable. This is the kind of analysis that Santiago Capital has been building for over a year piece by piece, from deglobalization to digital dollar dominance to the rewiring of the Western Hemisphere, all leading to this moment. If you want the full research, the scenario probabilities, the regional exposure maps, and the specific investment positioning behind everything I just walked you through, the link to the Santiago Capital Substack is in the description below. This is not a story that is going to wait for you to catch up. The planting window is closing, the ships are not coming, and the harvest is already decided. Subscribe now so you are not reading about this for the first time when it hits the front page.